Hey everyone, welcome back to Smart Finance Lab. Today we're talking about what's really going on in the markets, and what smart investors like you should do right now. No hype, just clarity. Look, I get it. Seeing your portfolio in the red hits different. It's stressful. You start questioning everything. And everyone on social media seems to have a different opinion on what to do. But here's the thing, your financial future isn't about chasing headlines or hot takes. It's about making smart, informed decisions that align with your goals. So let's cut through the noise and break down this market downturn. Let's dive in. So, what's causing this drop in 2025? It's a mix of factors. First, the Fed's still fighting inflation, and higher interest rates make borrowing more expensive. That hits corporate profits because their cost of borrowing goes up, and investor confidence takes a hit because their returns are lower. We're also seeing geopolitical tensions rise again, especially in key markets. Uncertainty breeds volatility, and that's exactly what we're seeing play out. Combine that with recession fears, and you've got a perfect storm for market volatility. But here's the thing, this isn't the first time we've seen something like this. Remember the dot-com bubble, the 2008 financial crisis, the COVID crash of 2020? Corrections and crashes are a normal part of market cycles. Think of it like this, the market climbs a wall of worry and sometimes it just takes a breather. It doesn't mean the climb is over, it just means we need to assess the situation, take a breath, and make sure we're prepared for what comes next. When the market drops, the first instinct is panic. You see the numbers in your portfolio going down and your brain goes into fight or flight mode. But here's rule number one, don't make emotional decisions with your money, ever. Panic selling locks in your losses. You're essentially selling your assets at a discount, guaranteeing yourself a smaller return when the market recovers. And it will recover. It always has. Remember, you don't lose money unless you sell low. Holding on to your investments even when they're down gives them the opportunity to rebound. Look, I used to be a real estate agent. I've seen people make rash decisions under pressure, and trust me, it rarely ends well. Timing the market is a gamble, and most people lose that bet. It's like trying to catch a falling knife. You're more likely to get hurt than to come out ahead. Instead of giving in to fear, take a step back. Breathe. Remember your long-term investing goals. This downturn is a temporary blip on the radar. Chapter 3. What to do instead. So what you be doing right now? Here's what smart investors focus on during a downturn. First, revisit your portfolio. Make sure you're properly diversified across different asset classes. Too many tech or high-growth stocks? That's risky during rate hikes. Remember, diversification is your best friend during times of volatility. Second, strengthen your emergency fund. This is crucial. Having a solid cash cushion means you won't be forced to sell investments at a loss if you face unexpected expenses. Third, consider dollar cost averaging. This is a strategy where you invest small amounts of money at regular intervals, regardless of the market conditions. If prices keep falling, you're essentially buying more shares at a discount, which will pay off in the long run. Fourth, look for quality stocks that are on sale. Strong companies with good fundamentals tend to bounce back from market downturns. These are potential buying opportunities, not red flags. Do your research, look for value, and remember you're buying a piece of a company, not just a ticker symbol. Remember, downturns are temporary, but good investing habits last forever. Chapter 4. Past crashes. Equal sign, future lessons. Let's take a step back and look at history. In 2008, the market crashed over 50%. People were panicking, selling their homes, their stocks, everything. It felt like the world was ending. Then, in 2020, we saw another crash, this time triggered by the COVID-19 pandemic. The market plunged over 30% in just a matter of weeks. But guess what? Each time, the market bounced back. And it didn't just recover, it soared to new heights. Long-term investors who held their ground or even bought during the dip were rewarded. Why am I telling you this? Because history, while not a perfect predictor, often rhymes. The market moves in cycles. There will be ups, and there will be downs. But understanding this cyclical nature can help you stay the course and make rational decisions. Remember, time in the market beats timing the market. The market's down, emotions are high, but smart investors you see the bigger picture. You're using this opportunity to sharpen your strategy, strengthen your portfolio, and set yourself up for long-term success. So, are panic selling or preparing to grow? Let me know in the comments below. If you found this helpful, hit that like button, subscribe to Smart Finance Lab, and tap the bell so you never miss insights that help you build wealth, especially during tough times.